All right, good afternoon, SVN. We wanted to welcome you today to the Industrial Market Trends call that's going to be hosted by CompStak. So, for all of you that don't know, we have an ongoing partnership with CompStak. What that includes is typically CompStak offers one-to-one comps, but for advisors that are part of the SVN network, if you sign up with CompStak, you're going to receive 8 free comps immediately and then 3 comps for every additional comp that's added. I'm going to let Brian go into more detail about what that deal actually looks like. He's the market expert on here. But yeah, we are really excited to have CompStak here today. What I'm going to do today is I want to introduce Brian Caldwell, who is the Senior Director of Strategic Accounts for the CompStak team. So without further ado, just again, take a good listen. We have some great information for you today. And Brian, I'll turn it over to you.
Awesome. Thank you, Julian. Happy to see all of our friends over at SVN today, and we've got some exciting programming for you. But first, as Julian mentioned, we've got a very robust partnership with SVN, and you guys have been great partners to the last few years as we support your data needs. So just for those of you who may not know, CompStak is the leading source for analyst-reviewed commercial real estate data, specifically leases, sales, and property level information. Access is completely free. And actually, as Julian mentioned, all of our SVN advisors get the most favorable trade ratio on our platform, where for every comp that you submit to us, you get 3 in return. So no one else has that arrangement, and that's all part of the partnership package for SVN. You also get a dedicated account manager that will work on my team. So anytime you need comps ran or have a question about finding a deal, you can reach out to us, let us know, and there's a dedicated person that'll take care of you. So a couple other quick things. So from time to time, we run promotions, and we've got our May promotion, which is May the Comps Be With You, where for every lease signed in 2025, if you send that to us, you're going to get gift cards, gift card rewards. So it's $3 for every first-time copy that we receive, and then you get $2 for every duplicate copy that you send in on our platform. So great time to gather your comps and send them over to us and see what kind of rewards you get. A couple more things. So if you're not following us on LinkedIn, please check us out. We've got some exciting new podcast content coming up. We'll have some broker spotlights where we will go into different markets and have a broker talk about market trends and things that they're seeing in their markets on our social media. So make sure to follow us and check that stuff out. And for the presentation today, I'm excited to introduce our experts. We've got Alie Baumann, who is our Senior Director of Market Intelligence, here to present, and also her right-hand man, Jacob Thomas, who's also on the Real Estate Intelligence team. So without further ado, I will turn it over to them, and we're looking forward to an exciting presentation.
Awesome. Well, thanks, Brian, and thanks, Julian, for having us. Today, we're going to do an industrial focus webinar for everyone. We're going to start with a little bit of a macro overview. What is the market looking like? How's the economy looking? And then we're going to do a spotlight of 2 recent reports that we've been working on. One is focused on air cargo and the industrial market around top airports for that market, and also a spotlight on small bay industrial. And we'll kind of wrap up with sort of what we think might be next for the industrial sector in this interesting time. And any questions, we'll have contact information at the end, and we will share the slides with everyone in an email after the call. So first, we'll kick it off with where are we now, the industrial sector in 2025? I think kind of the first major thing to start with is where are we with vacancy, which has changed a significant amount over the past few periods. So compared to the Great Recession, the 2020 recession was less disruptive to industrial occupancy, and actually lows in vacancy preceded that time, which is very different, of course, than the office sector. But more recently, industrial vacancy rates have been on the upswing. with the national average increasing 250 basis points since reaching a low at the end of 2022. So there's been some softness in the market, and this has preceded sort of the most recent kind of hit to the market, which is tariffs, which of course we'll talk a bit more later. So overall, as of Q1 2025, national vacancy rates are at 4%, which is their highest level since Q4 2017. And I'll back up and say that this is a vacancy rate index that is produced by NCREIF, the National Council of Real Estate Investment Fiduciaries. So it's focused on institutional grade assets. So different brokerages may have different sort of rates depending on what they include in their statistical set. So in this next slide, we're showing the Logistics Managers Index, which is an economic indicator that shows kind of how logistics managers are feeling about the health of the logistics market, which is a major part of the industrial sector. A reading above 50 means they think that metric is expanding, whereas below 50, it means that they think it will be contracting in the future. So sort of in this most recent period in March, the most recent reading, we saw a contraction month over month by 9.1%, which is fairly significant. And so while it's still above 50, it seems to indicate that logistic managers are feeling less good about the sector and could be an early indicator of future lower readings and confidence. So before the 2025 tariff rollout and all the changes that have been happening there, we continue to see expansion in e-commerce. So it actually reached its highest level since it did in the middle or the beginning of the COVID pandemic in Q2 2020. So this seemed to indicate that industrial sector participants should be feeling good about this part of the market. E-commerce was projected to continue increasing, which of course is a major tailwind for further warehouse and logistics growth. But we might see some changes going forward. So far, we haven't seen retail sales decline. We've actually saw them increase month over month in March. And this doesn't necessarily mean that tariffs won't impact retail sales. It could be an indicator of users trying to get ahead of making major purchases, or just ramping up what they need in advance of concerns about the tariff or economy. So this all ties into how the American consumer is feeling about the economy, which is a big part of what can impact the industrial sector going forward. There's really two broad economic indicators that economists look to sort of measure how is the American consumer feeling and how are they acting. So there's the Consumer Sentiment Index, which I'm sure many of you have seen quoted in the news, as well as the Consumer Confidence Index. The Consumer Sentiment Index fell for the fourth straight month in April 2025. It's down 30% since December. So this reflects that consumers are feeling concerned about continued inflation, their personal finances, amid sort of the trade wars that we have going on now. Meanwhile, the Consumer Confidence Index declined in April as well. It fell to 54.4. So generally, they say when it's down from about 80, that means that a recession could be on the way. But you'll notice that there's kind of a divergence in the consumer confidence index for the present situation versus future expectations. So for the present situation, consumers are feeling okay-ish. It's really the declines are happening and what they think will be happening in the future, which sort of indicates that there's growing uncertainty affecting how we're feeling about the economy and the job market. And then talking about the job market specific and in regards to the industrial sector, we haven't seen major shifts yet. So the two broad parts of industrial employment are manufacturing as well as transportation and warehousing. So manufacturing employment has been wavering a bit. It's down slightly year over year. It's down about 1% from its February 2023 peak. Transportation and warehousing jobs, have continued to grow according to the most recent data. So no major changes there. But tariffs may have given a sort of a temporary lift to transportation warehousing as importers tried to get ahead of bringing in goods and maybe hiring a short-term workforce. I would say that we could probably anticipate that transportation and warehousing jobs could slow in coming quarters, yet they're still expected to outpace manufacturing in the near term. Of course, the broad goal perhaps of tariffs is to bring manufacturing jobs back. As of yet, we haven't seen that, but these two sort of measures could change over the course of the next few quarters and year. Going back to tariffs, I'm sure everyone, including myself, is maybe a little feeling like that is every other word in my mouth these days. But what we're seeing so far is that import volume has shown a sort of recent uptake in recent data. So in Q1 2025, the US imports of goods and services reached an all-time high. It jumped quarter over quarter by nearly 10%. This was the largest increase since Q3 2020, which sort of was like a time when many pandemic restrictions were lifted and we were able to return to sort of previous levels of trade. So this spike, again, may have signaled that importers were trying to get ahead of tariffs to stock up on goods, which of course is a sort of short-term tailwind for industrial. But we can expect that there'll be a sharp decline in import volumes in coming quarters when the Q2 data and future data is released. So digging into tariffs and imports specifically from China, which is kind of a big part of what the industrial market is. So tariffs on Chinese imports, based on today, when I last checked, they're about 145%, and we're already seeing impacts visible in the data. So imports from China have declined for the past 2 months of data that we have, which was February and March. In February, they declined 24% month over month. That was, again, the sharpest decline since we saw in early COVID. Imports fell again in March. And I think we can anticipate that future months would show even more severe declines. So how is all of this affecting, port volume? In the next segment, we're going to talk about shipments that actually come in via air cargo, but here we're talking about shipments that come in via ports. So we did see an uptick year over year in what was coming into West Coast ports specifically. So that's LA, Long Beach, and Oakland, that there was an increase year over year, 13% for those ports, which outpaced the growth on the other side of the US on the East Coast. So this was probably driven by a pre-tariff import rush, likely many of those goods coming from China, which has significantly high tariffs. And we can expect there'll probably be a reversal in upcoming quarters with sort of volume maybe outpacing the West Coast on the East Coast, which of course has impacts for the industrial sector on the West Coast, probably more so than the East Coast. So that kind of wraps up our high level overview of what's happening now. At the end, we'll talk about what we may think would happen in the future, but I'm going to turn it to my colleague who's going to give a snapshot of what we covered in our latest release report, which is about air cargo volumes in the industrial sector around major airports for top cargo volume handled. So here you go, Jacob.
All right, thanks, Alie. So let's get into air cargo and its impact on industrial demand. Nationwide, U.S. air cargo volumes declined year over year in 2023. According to the FAA, their numbers showed it was down 5.5% in 23 from the previous year. But this phenomenon wasn't unique to the United States. The trend was largely a reflection of international air cargo demand, which also fell during that time. Among the busiest airports in the country are those shown here, with Miami International, we found was the only one of these four ports to post year-over-year growth in 2023. And while the FAA has not yet released its official data for 2024, the International Air Transport Association has reported an annual uptick of over 11% in global air cargo activity. And so I think we can expect similar happenings in the United States when the FAA releases their numbers. So let's talk about where all this stuff is going. Where's the air cargo headed? So overall, about 24% of cargo originating in the US has an international destination, while 76% of cargo originating in the country is transported to other domestic destinations. Of the four select airports, Dallas-Fort Worth, Miami, LAX, and Chicago O'Hare, nearly 60% of their outbound cargo is headed for international destinations. And it's surely no surprise to anyone that across key air cargo hubs, China is consistently ranking among the top international origins for US bound air cargo. So, what's getting transported? Categories of goods such as food, beverage, agriculture, and machinery and equipment dominate air cargo coming in through these key ports, accounting for over 68% of total imports versus 45.5% exports. And there are some risks faced by these airports, and they are not all equal. In terms of air cargo, LAX is particularly exposed to tariff risks due to a greater share of imports coming in from China, compared to the nation's average 18.3% coming in from LAX or from China versus 54% for the rest of the country. So goods such as apparel, textiles, footwear are also among those tariff-sensitive categories, which together account for over 1/5 of LAX's China-originating air cargo by weight. Moving on, it would be impossible to talk real estate without touching on location, location, and location. And that certainly matters for industrial property proximate to these airports. Airport hubs serve as cargo hubs due to factors like strategic location, proximity to highways, and manufacturing centers, as well as robust infrastructure and the ability to get your goods through customs efficiently. And overall, CompStak's analysis found a clear rent premium for those industrial properties located within a 5-mile drive of these primary air cargo ports. And those premiums ranged from 12% for Miami International to 24% for LAX compared to the broader industrial markets in their respective regions. And of these, LAX recorded the highest average in-place rent at $21.80 per square foot. Moving on, as you can see, proximity does pay. Since 2019, Chicago, Dallas-Fort Worth, and Miami industrial markets recorded stronger growth in starting rents within that 5-mile radius of their respective airports compared to the rest of the market. And growth within these areas ranged from 48% to 94%. And the smallest gap was in Miami, where rents near the airport outpaced the broader market by just 30 basis points. So a little bit smaller difference there. In DFW, in particular, starting rents proximate to the airport rose by nearly 5 times the rest of the market. So big difference at DFW. So the tenants in transportation, warehousing, storage, all along the supply chain make up the lion's share of tenants within this 5-mile distance, accounting for over half of tenant occupancy compared to 33% for the rest of the markets. And CompStak also found some regional differences in terms of who the top tenants were by total square footage. In terms of top tenants by square footage, floral, logistics, cold storage providers, those were the biggest tenants in Miami, while aerospace and defense firms like Boeing, SpaceX, Northrop Grumman, and the like, they ranked as top tenants near LAX. So let's talk opportunities. Strong air cargo numbers for last year are expected to be released, and prior to the announcement of tariffs, this year looked pretty optimistic. E-commerce has been on a multi-decade upward trend, and I honestly don't think it's very likely for it to reverse that long-term trend in the short term. And there is ongoing investment in infrastructure to meet that demand around these airports. There are risks associated, of course, always risks for industrial and air cargo, and that includes tariffs, the removal of something called the de minimis exemption. It was an exemption that was removed for Chinese goods that previously allowed for shipments under $800 to enter the U.S. duty-free. And so that is now gone. There's also the international conflict causing disruptions in shipping in the Red Sea that could also translate to higher costs, and of course, lower consumer confidence. And now I'm going to hand it back to Alie.
Great, thanks, Jacob. So now we're going to shift slightly to sort of a somewhat broader look, but also focused on another part of the industrial sector. This report is not yet released, but it's sort of a preview of what we'll be speaking to. So this is about small bay industrial, which probably doesn't get as much attention as sort of the bulk warehouse sector, which we hear so much about, those mega users taking million square foot leases. So, as I said, the spotlight has largely been on bulk warehouses. And over this, most recent period of industrial softening, that's where we heard a lot about the kind of decline in rents, increasing concessions, longer periods to lease up. That's also been where most of the new construction has focused on building, warehouses that are larger in size. So there's a big debate about what is the strict definition for small bay, but generally most people think of it as buildings that are 150,000 square feet or smaller. Tenants within those taking spaces that are 100,000 square feet or smaller. For this report, we analyzed trends from 2015 through 2024. And we focused on 9 key markets that stood out for small bay in general. These included Atlanta, the Inland Empire, the greater Los Angeles area, Miami, Chicago, the Bay Area, Dallas, Fort Worth, the New Jersey North and Central Corridor, and San Diego. So in our research today, we found that across these markets, for the buildings that are 150,000 square feet or smaller, which I said is how we define small bay industrial, we did find that they lease at higher rates per square foot than bulk warehouses. So this analysis tracked starting rents for deals executed annually since 2015 and showed that smaller warehouses consistently commanded higher rents or a rent premium on average through 2024. The premium did narrow during this sort of most recent peak rent period for industrial rent in the broader market during the 2022 to 2023 period, but it still remained in place. So across the markets analyzed, the average starting rent premium for small bay peaked at 61% in 2019. It declined to 28% in 2022, but it's consistently stayed in the double-digit periods in this broad market overview. What else defines small bay industrial? So beyond it in general commanding higher rents per square foot and bulk industrial, on average, small bay industrial tenants are also taking shorter lease term lengths. And that is one of the key advantages if you're a small bay industrial owner, as well as defines the market. So this can allow landlords to reprice their assets more frequently. Leases are turning over, they can take advantage of recent market rent increases and capture rising rents sooner. So overall, we found in 2024, if you were a small bay industrial building that's multi-tenanted, the leases averaged about 48 months in length. If you were a small bay industrial building that is occupied by a single tenant, your average lease term length was 57.7 months. Bulk industrial was significantly longer on average, that was about 71.3 months. So this greater lease flexibility enhances rent agility, so you could be more responsive to positive market shifts. Who are the tenants and industries that are taking small bay industrial? So this was sort of an interesting thing that we found. In general, they serve a more broader, more localized tenant base. Small bay industrial is more likely to be closer to the city center, to be in more urban infill locations, and they tend to serve more localized users rather than probably participate in a broader, more global supply chain. So we found that manufacturing actually figured a lot more heavily for the share of occupancy than it did for the bulk industrial market. Now it's usually light manufacturing or related support industries, local contractors, specialty trades, or perhaps showrooms or warehouses for sort of locally made goods. Last mile logistics also figured as well. Whereas in contrast, bulk industrial is more heavily occupied by third-party logistics providers, large logistics firms, and also brick and mortar retailers that are using space for distribution centers for their stores. So again, we wanted to explore the rent premiums that exist for if you're occupying a small bay industrial building by yourself or you're sharing with other tenants. So the answer is in general, tenants will pay more to have their own space rather than share. So in 2024, for example, we found that single tenant leases under 25,000 square feet averaged $16 per square foot. Multi-tenanted leases under that size average $15.34 per square foot. But as you can see across these three charts, the premiums and differences between rents differ by size, meaning the size of the lease. So in general, we found that single tenant leases paid more to occupy larger spaces than smaller. And these premiums remain relatively consistent across both strong and softening market cycles. So as I mentioned earlier, we studied nine major US markets. What are the trends by individual markets? So overall, we found that there was a single tenant rent premium, but there's some important differences and local factors certainly matter. In 2024, 8 of the 9 major US markets that we analyzed saw higher starting rents for single tenant small bay leases compared to multi-tenant ones. However, the premiums can sort of differ significantly by market. We noted that 5 markets, Atlanta, Chicago, Dallas, Fort Worth, the greater LA area, and northern central New Jersey consistently outperformed for single tenant small bay versus multi-tenanted small bay across metrics like what was the average starting rent in 2024, what was the year-over-year growth in that starting rent, and sort of the compound annual growth since 2019. While single tenant small bay leases often command higher rents, we also found that multi-tenant small bay industrial performed well and at times had outperformed their single tenant counterparts in market. So a closer look at the market level trends revealed contrast in performances specific across Atlanta, the Inland Empire, and the Bay Area, which we noted of interest. So overall, Atlanta stood out. It led the pack for multi-tenant small bay rent growth, both since 2019 and on a year-over-year basis. In contrast, the Inland Empire, which broadly got a lot of attention for being the fastest growing rent growth market for bulk industrial as well, it saw strong long-term gains, but has recently declined as that market had some market softness over the past year. And interestingly, the Bay Area ranked lowest for cumulative growth and had the weakest year-over-year change in rents. So digging in further to the single tenant premium, we found some interesting findings. We showed that it's very difficult to pinpoint an exact premium per market over certain periods. We found that it varied, and it sometimes did turn negative for one market. During the most recent period, 2023 to 2024, the highest single tenant premiums were recorded in the Bay Area, Dallas, Fort Worth, Chicago, and northern central New Jersey. These 4 markets, along with the greater LA area, stood out for relatively consistent singleton premiums across these 3 periods. But the other 4 markets showed mixed results, with some having negative or inconsistent premiums. And why would this be? So we noted that there's a lot of factors that could influence this that are difficult to isolate. Lease length, specific location, is it small bay, an infill area, or suburban? What is the layout of the building? Tenants in general pay premium to occupy their own space because they want control, right? That makes sense. Ability to customize, brand the building, but it's hard to isolate the rent premium for single tenant spaces that may have had that versus not had that as much. From an owner's perspective, the premium usually exists because you can get long-term tenants that want to occupy their own building, but there also are market risks. When the tenant leaves, of course, you're 100% vacant and you need to find a new tenant. Multi-tenant buildings spread risk, but require more active management of your rent roll. So looking ahead, how are we feeling about the small bay sector? Because of what I noted earlier, there's been limited construction in this area, buildings smaller than 150,000 square feet. Most of the new construction has been for mega warehouses and large industrial properties. There still are opportunities since it's sort of a constrained supply. And there also may be constrained supply in specific locations that have key advantages in the supply chain, such as last mile location. However, as we've said several times, recent tariff changes actually may affect small businesses more than bulk industrial. They tend to have lower margins, limiting their ability to absorb higher rents, and possibly having an impact in the small bay sector, depending on what their key industry of focus is. So while the sector shows resilience and deserves more interest, investors should pay attention to economic indicators and tenant industry instability based on what's happening in the current trade environment. So, and with that, I'll turn it back to Jacob, who has a crystal ball, and he'll give us a quick summary of what could be ahead for 2025.
Thanks, Allie. Yes, let's take a quick look at what could be coming down the road. Um, Related to the point made earlier about industrial showing signs of moderation even before tariffs were announced, CompStak's industrial rent index peaked in Q4 2023 and ever since has been on a downward trend. It did drop 2.3% in the fourth quarter of last year to this quarter. That was the largest quarter-over-quarter drop since Q4 2010, and that suggests that tariffs have already caused some decline, though rents are still well above where they were 5 years ago. Just for reference, that 2010 drop came after the official end of the Great Recession in June 2009, though some market softness persisted well beyond that point. If this uncertainty in the industrial sector continues, it could prompt landlords and tenants into signing shorter lease terms with lower escalations and more free rent. We can see that the ratio of free rent to lease term has ticked up a little bit recently. It's up 180 basis points since late 2023, and average annual escalations are also down a bit at 15 basis points. So who knows what's going to happen? We'll see. And with that, I will hand it off to Allie, who will wrap us up.
Thanks, Jacob. Great summary. Yes, we have interesting times for the economy and industrial sector overall, and we'll be monitoring this going forward. So I just wanted to thank everyone for joining us for SVN and having us on to present, and Brian and Julian, who joined earlier in the call. If you have any questions or comments, here's our contact information on the screen. Sarah Aries is your account manager, and also that is our email for our market intelligence team. We'd be happy to hear from you or try to answer any questions that you have on this content or other topics. And then one last plug to follow us on social media. We post content like this all of the time, and also we send out several newsletters monthly with market intelligence information like this, various reports, and topics about the commercial real estate environment in general, and also in the retail and office sectors as well. And the last thing I'll say is we also have a podcast, which is a Not a Podcast, and you can find that on YouTube as well as Spotify. So thanks, everyone, and have a great rest of your week.